Hello, investors and traders. I will explain the demand index and how to use this technical indicator in your investing or trading strategy. I will go in depth on how to use this indicator and how to predict the overall market and individual securities. I will explain the importance of volume and the importance in adding volume indicators to your weight of evidence rule-based trading system. These indicators will also give you a weight of evidence every week in the stock market. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophies. If you put many of our videos together, you are starting to build a system and a trading plan which will ultimately make you a better trader or investor. There are no free lunches, so you know the catchphrase: study it, analyze it, adapt it. What is demand index? The demand index is a complex technical indicator that uses prices and volume to assess buying and selling pressure affecting a security. The demand index is a complex technical indicator developed by James Sibbet that utilizes over 20 columns of data to measure the ratio of buying pressure to selling pressure. Traders can use this information as a leading indicator that predicts where a security's price may be headed over the near and long term. The importance of volume. The next important factor to concentrate on is volume. Once you learn to spot this telltale clue, you will be well on the way to separating the so-so buys from explosive big winners. Even if we were never to discover the reason why volume is so important, a quick look at any chart book convinces you that volume confirmation on a breakout is crucial. There is, however, a very good reason why volume signals really work. Volume is a gauge how powerful the buyers are. As I said earlier, stocks can fall off their own weight, but to advance, it takes plenty of buying power. It's no different from pushing a boulder up a hill. It takes tremendous expenditure of energy to move it up the hill, but once you let it go, it can build up plenty of downside momentum on its own. The rules is very simple. Never trust a breakout that isn't accompanied by a significant increase in volume. The demand index will assist exactly how technical healthy patterns should unfold volume-wise. When the stock is in a base area, the volume pattern will be erratic. My studies have led me to a different conclusion than many technicians. Some believe there must first be a spike that shows the final panic dumping of the stock. They feel the volume should then contract, dry up, showing a lessening of selling pressure. While this is a nice theory, I've seen far too many charts with far different volume formations that turned out to be big winners. So to keep things simple yet profitable, I wouldn't worry what shape the volume pattern takes while it's forming a base. However, once XYZ breaks out above the top of its resistance area and moves above its 30-week M&A, I want you to worry plenty about volume. As many breakouts show, volume should pick up significantly on the breakout. If it doesn't, the probabilities are very high that at best you got a mediocre winner and on your hands that will advance only a few points. At worst, the stock will turn out to be a false breakout that will soon be back in the trading range. Investors always want hard and fast rules, and too often we technicians are guilty of complying. I don't agree there's a magic level of volume necessary for identifying a winner. Rather than looking for breakouts that have randomly picked numbers such as 4.65 times the average volume of the past few weeks, I look for the following: either a 1-week volume spike that is at least twice the average volume of the past month, preferably if it is higher, or a volume buildup over the past 3 to 4 weeks that is at very least the average volume of the past several weeks, coupled with at least some increase on a breakout week. Whatever the exact number is, there is no significance in the increase of volume when the breakout occurs. Then avoid that stock. If you have purchased it with a buy stop order, then sell it for a fast profit when it advances after the breakout, which it will usually do. First, we want the market trend to be bullish. Second, the groups should be positive. In addition, the chart from that favorite group must be breaking out with a minimum resistance overhead. Finally, volume must confirm the breakout. Look at how many checklists we have, how you can separate the good from the bad and the ugly. In addition to this basic requirement of stock being above the MMA, the following three events must take place. First, there must be a volume signal. This is vital. The market champs also always have substantial larger volume on the breakout than during any point of the base area. For this type of big winner, we want to see volume even more than twice the average trading of the past 4 weeks. In addition, the heavy volume should not be short-lived. The initial volume surge should be followed by several more weeks of heavy trading. The signal indicates a sudden tremendous interest in a stock as well as additional future demand. Since the stock is starting to run away on the upside, buyers will be fast to add positions on the correction. When the dips are too shallow to accommodate their buying, these buyers will often get into a panic buying.
Let's go to the charts. The demand index. The first indicator, or the first way that I look at the demand index, is at extremes. I want you to just look recently at the extreme level on the bottom that has not reached in a year, and then look at the pop. The same thing goes for oversold areas or overbought areas. Again, extreme levels goes lower. Extreme levels goes higher. Now, again, this is not an overbought or oversold indicator where you can say, oh, now it's suddenly overbought or oversold. But at extreme levels, this works very well. The next thing is, let's look at the demand index on a line. We were looking at a histogram. Now let's look at a line. When the line turns from the bottom and is headed upwards, another indication that this is going upwards. Or using the line, demand index turns lower, this goes lower. Above zero and below zero has always been historical great for this indicator. So when you have a lot of indexes, a lot of ETF and sectors above the zero line, it works very well that you are in a bull market. If a lot of the ETFs and sectors are below the zero line and stays below the zero line, we are in a bear market. So let's review. Histogram, demand index. If you are at extremes on the histogram, it will move in the opposite direction. Then you follow the line, usually a close line, 5, 10, and watch it move upwards. Crosses above zero, positive indication. If you stay in above zero for long periods of time, it looks great that this is in a bull market. If you stay in the below zero, this could go lower. This indicator uses price and volume in its formula. A great symbol to use, volume.
6 rules for demand index. James Sibbet established 6 rules for using demand index when the technical indicator was originally published. While traders may use variations of these rules, which we do, they serve as a greater baseline for using the indicator in practice. The 6 rules are as follows. A divergence between the demand index and price is a bearish indication. Prices often rally to new highs following extreme peak in the demand index. Higher prices with a low demand index often indicate a top in the market. The demand index moving through the zero line suggests a change in trend. The demand index remaining near the zero line indicates weak prices movement that won't last long. A long-term divergence between the demand index and the price predicts a major top or bottom. Traders should use the demand index in conjunction with other technical indicators and chart patterns to maximize their odds of success. Demand index is not a standalone index. I would consider it more of a weight of evidence building a verdict of which direction the market is going or how is the security going, always looking at the macro picture.
The most powerful stocks are breakout stocks, where you have a large basing of a company and then suddenly it breaks out. We look at the volume a lot. There is no magic number, 5 times the amount, 10 times the amount, or whatever number you have. But the demand index will help you tell you that there is a lot more buying pressure when this stock breaks out. And as you see by this stock pattern, it was basing for months and then suddenly higher volume breakout, and the volume kept continuing at higher levels. This especially works on the buy side. It does not work as well on the sell side. So breakouts with a higher than usual, maintaining above a zero line and maintaining the higher volumes, is a great indication that this is a long-term winner.
For further explanations on indicators, watch our videos on KST, Know the Sure Thing Indicator, MACD Explain, and Top-Down Strategy Explain. Please subscribe and turn on notifications for our weekly updates on the stock market and cryptocurrencies. You know what I'm going to say. Study it, analyze it, adapt it. Peace.